You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Dana Peterson, Chief Economist and Leader of the Economy, Strategy, and Finance Center at the Conference Board. I'm also your guest host for today's episode. Joining me today is Stephanie Guichard, Senior Economist of Global Indicators, and Erik Lundh, Senior Global Economist. In today's conversation, we'll discuss the latest U.S. consumer confidence, as well as our outlook for the global economy. Welcome, Stephanie and Erik.
Great to be here.
Good to be here. Thank you.
All right, well, let's start off with the Consumer Confidence Index. So, Stephanie, how are consumers feeling in April?
So, in April, consumers are feeling very pessimistic about the future. Our expectation component was the lowest since October 2011. So, it's very high anxiety about the future. However, need to add, they are not too depressed about the current economic situation. So relatively happy about the present, very anxious about the future.
Well, did the survey reflect any concerns about tariffs or financial market gyrations?
Yes. So, and in our survey, we asked consumers what is driving their view about the economy. And we got a lot of responses mentioning the tariffs and the trade issues. We also saw some higher than usual responses referring to the stock market. So indeed, tariff and financial market gyrations really affected their mood. And this is most likely what has driven down their expectations for the future.
Well, given this erosion in expectations, are more consumers anticipating recession in this survey?
Yes, indeed. And so this month we got an increase in the share of consumer expecting a recession. We are now close to the heights that we saw in late 2022 and early 2023 when, if you remember, but this was a time where everyone, including most economists, were indeed expecting a recession.
Wow. So do you think how consumers felt in April will impact their behaviors going forward?
So that's not clear because, we've been in this kind of situation last year where consumers were relatively happy about the future, very anxious, very happy about the present, very anxious about the future, and they kept on spending because at the time, the labor market was strong and they were anxious, but they were still using their credit cards and they were still shopping. So maybe we're going to be in the same situation as last year. However, we see some signs that are suggesting that potentially not. And I'm going to tell you what's the most worrying trend in this survey is how people are feeling about future income. So remember last year, they were anxious about the future. They were still happy about their future income. Right now, not only they are concerned about the economy, they are concerned about the labor market, they are also concerned about their income in the next 6 months, which means that their overall concern about the economy have become much more personal. And this is where potentially they may start thinking about, do I really need to buy this? Should I wait for some time? Maybe I should start saving money. So we could see some changes in consumer behaviors. And in fact, we've seen some already in the first quarter of the year where we had a slowdown in consumer spending.
Wow. All right. Well, let's dive into the details here. Well, okay, you mentioned that the expectations really move the overall measure. So what in particular within the expectations gauge caused the decline in confidence?
So everything. So that we have three components in the expectation index. Consumers' views about business condition in the next 6 months. That one was already negative. It became more negative in April. We asked consumers how they feel about the labor market going forward, whether there are going to be more jobs available or fewer jobs available. It was already in negative territory in March. It got worse in April. And then the last one is the income component. And on that one, as I mentioned, they were still optimistic in March, close to neutral, and now it's clearly in negative territory for the first time in about 5 years. So it's really the three components that have driven down the expectation index.
Well, there are two components in the current conditions measure. Which two kind of held that measure afloat? Which one, rather, held that measure afloat?
So the one that is really, playing on the level is assessment of the labor market conditions. If you abstract from the slight ups and down in the different months, overall, consumers still think that the labor market is relatively strong. And this is matched by, the data we've seen so far. We saw some slight weakening of the labor market, but overall, unemployment hasn't increased dramatically. Layoffs haven't increased dramatically. So overall, the labor market is still up to now relatively healthy. And this is really supporting consumer assessment of the present situation.
That's great. Out of all this bad news. Well, you did mention earlier that consumers are starting to worry more about their incomes. So were there any big changes in the components that ask about consumer finances, both now and in the future?
So we ask consumers about their family financial situation, both now and in the next 6 months, and both measured have weakened substantially in April. This is a relatively new question, so it's very difficult for us, and we don't have the whole history. We started to ask these questions in 2022, but we are now close on both the present and the future to the lowest level since we started to ask this question in 2022.
Well, speaking of finances and incomes, what do consumers expect for the stock market ahead? And I ask this because a lot of consumers look at the stock market as a gauge for future employment.
Yeah, so that's a very interesting one because we have seen a complete reversal in terms of consumers' expectations for the stock market in the past 6 months. So we were at an all-time high in November, December last year, and now they are completely shifted. So now we have 48% of consumers expecting stock prices to decline over the next 12 months. This is the highest share since October 2011. And we don't necessarily remember what happened in 2011, but in 2011 we had a stock market crash during the summer, and then we had a lot of volatility. So we are kind of back to that point. So it's really a complete shift in consumers' expectation regarding the stock market.
Okay, what about inflation expectations? I know in the previous month they really shot up. Did we see worsening in that trend?
Yeah. So it continues to worsen. So now we have inflation expectations at 7%, which is as high as in 2022 at the time where inflation was record high. And so overall, and since November, we had a 2 points increase in inflation expectations by consumers. What's very interesting to note is, like, if you compare to 2022, in 2022, you had an increase in inflation, and this was matched by some increase in inflation expectations. So people were looking at this. So prices were increasing fast, and they upgraded their inflation expectations. Right now, so far, inflation has been relatively stable in the past few months. We haven't seen this spike in inflation, but consumers are still worried about inflation going forward. So so this time around, we see inflation expectation jumping up without seeing it already in the inflation data. And I think that's very interesting.
But isn't it a reflection of tariffs or anticipated tariffs?
Most likely, because when we read the writing responses, so as I mentioned earlier, there were lots of references to the tariffs, and then when you go into the details of the responses, like many consumers were saying, I'm worried that there's going to be more inflation because of the tariffs.
Okay, well, the reason why we do this confidence survey is because businesses care a lot about consumer appetite. So, are consumers changing their plans for purchasing big ticket items?
So we start to see some weakening in terms of plans to buy cars or big ticket items. I mean, it's not nothing dramatic, but we've seen some softening, especially in April. We also see some softening in intention to go on vacation. So I mean, it's not, it's another type of expenses that are very high in overall consumer spending and in their budget. And we start to see some pullback.
Also, bond yields have been rising very aggressively. Was there anything in the housing or at least home buying intentions that might suggest consumers pulling back there?
Yeah, we also saw some slowing in intentions to buy a home. Could be linked to higher rates. It can be linked to the fact that home prices are still very high. And it's maybe also, people starting to think, well, I don't know what's going to happen in 6 months. I'm very worried. I may lose my job. So let's wait and see before we make these big decisions of buying a home.
Oh, okay. So just thinking about services, and services are a huge part of consumption. And there have been times where goods spending was a little weak, but services kind of took over. And indeed, in the retail sales data that we saw recently, people went out to restaurants. But you did mention that people are less interested in vacation. So, what are consumers thinking in terms of interest in buying services or more services ahead?
So yes, we ask consumers whether they are planning to buy more services ahead. And the same thing we saw with big ticket items, we also saw some softening in intentions to buy more services going forward. We get the breakdown in terms of in which item they are spending to spend more. And still, I mean, the favorite spending is dining out. So this is still the top in terms of spending intentions on services. However, dining out is also one of the categories that has seen the largest pullback in April. So still the top spending priority, but at the same time, one of the items in which they are planning to spend less.
Wow. So sad news on the consumer confidence front. Thanks, Stephanie, for that. We're going to take a short break and we'll be right back with you for more of our conversation.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite's Perspectives. I'm Dana Peterson, Chief Economist and Leader of the Economy Strategy and Finance Center at the Conference Board. I'm joined by Stephanie Guichard, a Senior Economist of Global Indicators, and Erik Lundh, Senior Global Economist. Earlier, we talked about the U.S. consumer. So, Erik, given what consumers have expressed in April in terms of their feelings, do our U.S. forecasts for 2025 agree with them?
Dana, they do, and I guess I should say maybe unfortunately they do. We are expecting to see the U.S. economy slow, especially over the first half of this year. We're watching real consumer spending. We've already seen that sort of stumble a little bit in the first quarter, according to the monthly data, at least. And looking a little bit around the corner, we're expecting to see consumer spending slow even more into the second quarter, and that's going to really sort of put a headwind on overall GDP growth over the course of the next several quarters.
So what's our overall expectation for GDP growth this year?
So we're forecasting that the U.S. economy expands by about 1.6%. That's versus about 2.8% for all of 2024. We started out the year fairly optimistic about the growth paradigm in the U.S. We were expecting to see something around the lines of 2.3% growth in January. But as events have unfolded, as tariffs have been announced, as consumer confidence has gotten lower, we've been downgrading our forecast. And so we've moved it from about 2.3% again at the onset of the year down to about 1.6% for the full year now.
Now, U.S. consumers' inflation expectations, at least for 1 year out, have skyrocketed. So how have we incorporated what consumers are thinking into our inflation outlook?
So, over the last 6 to 9 months or so, we've seen sort of a stickiness in the inflation story. We haven't seen inflation continue to cool at the rate that certainly the Fed had hoped. But we were optimistic that gradually over the course of this year, maybe into early 2026, we would get to that Fed target of about 2%. But given some of the announcements that have been made about tariffs, we're growing increasingly concerned about inflation, especially goods inflation, because goods, of course, are imported from abroad and subject to those tariffs. And so we've been increasing our inflation forecast. So at present, we're looking at inflation to probably levitate to somewhere 3.1% in the second half of this year, which is going to be a bit of change of course in terms of a lot of the progress that we saw in 2024 and 2023.
Well, given the massive amount of uncertainty that we've experienced in the first 4 months of this year, and many companies, even in today's news, kind of pressing pause on their activities, what's our employment and unemployment rate outlook for this year?
So, as Stephanie had mentioned, the employment the labor market is in a better balanced position today than it was a year and a half ago, where there was more of a demand for people than a supply of workers. And so we've seen some progress there. Unemployment is hovering at about 4.1% or so. But again, given the slowdown that we're predicting, we are expecting that the unemployment rate is going to rise a bit over the course of the next several quarters. And so we're thinking at this point we could see the rates rise to about 4.7% or so by the end of this year, which isn't a catastrophe, but it's certainly higher than it is today, and does show a little bit more slack in the labor market than we had expected just a couple of months ago.
Yeah, and I think it also reflects the fact that you do have these layoffs in the government sector, and you could have a number of people that find it difficult to find a new job after that. And so there are going to be more and more people filing into the unemployment ranks and having difficulty finding new jobs and getting out of there. So that could also potentially push up the unemployment rate.
Absolutely.
Yes. So will slower US GDP growth have any impact on the global growth forecast that we have?
It will. I mean, the U.S. economy is the largest economy in the world. If the U.S. economy slows down, it has an impact, of course, on the top line global growth number. So we're expecting the global economy to slow down from where it was just a year ago. We're forecasting about 2.9% growth for the full year versus about 3.2% last year. And of course, the U.S. consumer has a voracious appetite for all kinds of goods that are produced abroad. When tariffs are introduced, it makes those more expensive. It affects demand for them. And so just the direct sort of cascade of more anemic U.S. consumer demand for goods that are made abroad are going to have an impact on a lot of economies that are accustomed to being able to send things to the U.S. for U.S. consumers to buy.
So what are some of these economies that might weaken and contribute to the slower global growth due to the if the U.S. Fulfills its promises on these tariffs?
Well, it's fairly broad. Some of our closest neighbors, for instance, Canada and Mexico, have a fairly high GDP exposure to the U.S. And so while these tariffs have been implemented, it affects that the demand, which is going to really knock them in terms of their abilities to grow. Other economies around the world in Southeast Asia and India, Asia, are all going to be affected as well.
So that's our base case. So let's talk about risks. What might prompt downgrades to our forecast? I mean, it already sounds pretty downcast. What are some downside risks that you see?
Well, I mean, the tariff situation is evolving, it seems, day by day. We did get a 90-day pause on a variety of the tariffs that were implemented on April the 2nd. So we're watching that story closely. If that is unpaused and those rates are re-implemented, especially for a longer period of time, a full year perhaps, that could introduce additional weakness into our expectations for global growth. And of course, if the U.S. economy potentially does even worse than we're forecasting, if we do see a recession, which again, we're not forecasting yet for the U.S. economy, that's going to cascade as well into other markets too.
Well, so that we could end on a high note, what might cause us to upgrade our forecasts?
Again, a lot of it comes down to tariffs and to uncertainty. Businesses in the U.S. have really been sideswiped by the amount of policy uncertainty that we're seeing. They're concerned about hiring. They're concerned about deploying capital. It makes them a little bit more reluctant to do things that promote economic growth. If we see more certainty, if we see a pullback on tariffs, a more of a clear vision from Washington, that could introduce upside risk for the U.S. economy and the global economy as well. And on this tariff story, if a lot of these tariffs are negotiated away via bilateral negotiations between Washington and various other capitals around the world, that's going to create sort of more certainty and more of a tailwind relative to where we currently see things moving over the course of the remainder of this year.
Okay, well, that's a very U.S. focus. What about Europe? Europe is kind of stuck between, two giant powers, the U.S. and China. Do you think Europe is going to potentially see faster growth as they try to adjust to this new dynamic?
So our forecast for Europe doesn't really show a tremendous amount of improvement over the course of this year. We're forecasting about 1.1% for the full continent versus about 1% growth that came in at for last year. There are a number of developments that are occurring in Europe. There are continued easing among central banks on the continent. There have been some programs that have been announced on infrastructure investment, on increased investment in defense spending in Europe. So those all have the ability to accelerate growth potentially more than expected over the course of the next 9 to 10 months and into 2026 as well. But certainly, a cessation in terms of the hostility on the trade front would be beneficial for Europe too.
Do you think there'd be, and this is my last question, will there be any economies that might benefit from the substitution effect?
It's a real possibility. I mean, we do have, exceptionally high tariffs currently in place on China. If we see those continue, we could see some manufacturers or pivot moving into Southeast Asia, moving into potentially Mexico. But again, that's going to be contingent upon some of the trade strife between those economies and the U.S. moderating as well. So it certainly has the potential to reshuffle global value chains and global supply chains. But right now, there's not really one clear winner that you can identify given the environment.
Okay, well, there is a little bit of good news in there. Well, let's wrap up this conversation. Thank you, Stephanie. Thank you, Erik. Thank you for being with me here today.
Our pleasure.
And thanks to all of you for listening to C-Suite Perspectives. I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.